I got this, my A+ market mechanics strategy. It's stupidly simple, it's mechanical, and it made me over $100,000 last month without staring at charts all day or guessing every move. So in this video, I'm going to show you exactly how this works and why most traders overcomplicate something which should be painfully obvious. Now, most traders fail because they trade every single setup that looks good enough. They trade 6 to 10 different currency pairs with zero focus whatsoever. And most importantly, they can't even define what an actual A+ setup looks like. Now, I used to be the same. I would take mediocre trades every single day, thinking that more trades equal more money. But the truth is, one A+ setup is all you need to flip your entire week. Once I filtered my system down to only one setup, my win rate jumped, my emotions dropped, and my results skyrocketed. So this is the exact framework that I use today, and it's how I make over 6 figures a month consistently. Now, I call it the A+ setup filter because it's not about catching every single trade. It's about waiting for the cleanest setup that checks every single box. Alright, so with that said, let's break down this entire diagram step by step. So over here, we got a bullish break of structure to the upside, which means that we can identify our swing low and our swing high, right? So we know that this is the entire swing range that we should be focusing on. Okay, so in this case, price was actually bullish since we already got like a higher low being formed right here, and we expect price to start shifting bearish when it mitigates some form of supply zone that we have on the left hand side, right? And this means that potentially sellers is going to be coming into the market and it's going to push the price down. And when that actually happens, we know that price is potentially shifting bearish in the short term to actually facilitate the higher time frame pullback, right? So we know that price over here starts creating lower high, lower lows, and this does not mean that the trend has officially shifted to bearish. It just means that it shifted bearish temporarily to facilitate a pullback. Okay, so in this case, what we had was that we got a market shift right here where price actually took out that last internal high low, which show us that the pullback is starting. Okay, so in this case, the internal order flow, the internal structure has shifted from bullish to bearish, right? So right now, since the internal structure is bearish, we want to be looking for sells. It's going to be high probability to actually look for sells. Now, speaking of probabilities, I've actually split the different phases of the market into scenarios where you can trade, and I have literally ranked them based on your odds of success, right? So there's high probability scenarios, which is the A+ setups that you want to be taking. And then there's also your medium probability scenarios. And then there's also your low probability scenarios, which you want to avoid at all costs. Now, you must understand that retail traders think in black and white. They have this binary thinking where they think that, okay, it's either I win or I lose the trade. But that's not how it works. That's not how the market works. That's not how life works. Professionals, they think in probabilities. They are looking to trade those high probability setups, those A+ setups, which will actually give them a bang for their buck. So my friend, the wisdom of the day is that the market isn't a quiz with the right answers. It's a game of controlled risk. It's all about preserving your capital for these high probability scenarios which you want to be trading. So with that said, let's go through the high probability scenarios first, right? So over here, like what we have, internal structure has officially shifted bearish after we got a market shift. So we know that all of this is actually pretty high probability to short from, right? All of these supply zones that we have right here. You should be looking for sells right here because we are looking to ride the pullback all the way down to discount pricing. Okay, so once price comes down to this discount pricing, and we know for a fact that price could potentially create a new high low anytime right now, it becomes low probability to look for sells, right? So this is where you want to start looking for longs. But the trick here is not entering for longs too early or not entering for longs too late. It's entering at the right time, the perfect time, so we can actually trade with precision, right? So over here, when price actually came down there and mitigate this demand zone that was being created right here, it was actually low probability. The reason being there was actually available liquidity sitting below this low right here, and there is also available liquidity sitting below this low that we have on the left hand side. Because we know that retail traders will enter for a buy somewhere right around here looking to ride this continuation leg right here. They are placing their stop loss below these high lows right there, which generates available liquidity for us, professional traders. That is why even though you are entering for a buy at a demand zone within discount pricing, it is still considered as somewhat low probability, mainly because there is available liquidity sitting below this low right here. And price has also not mitigated the extreme point of interest. Okay, so you can see right here, this is the extreme zone, the extreme demand zone, which was created from this swing low that led to the break of structure that we have to the upside, which tells us that this is the last line of defense. So this low right here has to hold in order for price to actually remain bullish on the higher time frames itself. Okay, so in this case, when price actually come down there and mitigate that extreme low that we have right here, is actually medium probability. The reason why it's not high probability is because the internal order flow is still bearish, right? Internal order flow has not shifted bullish yet. So we are still trading against the internal order flow, which makes it medium probability. But because of the fact that it is at this extreme point of interest, it is not considered as low probability. Okay, and bear in mind that this area right here, it's also medium probability. Main reason is because if you are trying to look for shorts at this supply zone, right, you are still trading against the internal bullish order flow, right? You can see right here, the internal structure is still heavily bullish, right? So there's a high chance that price can just make like a small pullback just like this and just continue heading up even higher, which makes it medium probability to look for shorts right here, right? So basically, high probability scenarios are those scenarios where you are trading with the internal structure, with the internal order flow. So over here, when price has actually mitigated this extreme point of interest, look at what happens next. We got the internal order flow started shifting bullish, right? When price actually went up there and take out that last lower high in the previous internal bearish order flow, which signaled to us that the pullback is actually over. And right now, the internal structure is shifting bullish, which aligns with our higher time frame structure itself. Right, so in this case, it's going to be extremely high probability to look for longs at all these higher lows that we have right here, because now the internal structure is bullish, higher time frame structure, swing structure is also bullish as well. Okay, so in this case, what we had was that price started pulling back after the market shift. This is where you can look for longs, right? Because you are trying to trade with on this internal high low right here, and then this internal high low later led to a break of structures to the upside. And bear in mind that it's gonna be low probability to look for sales at these supply zones that we have right here, because internal is already bullish. You always want to be trading with the internal order flow, right? So later on, price actually pull back. And where did price pull back to? It pulled back to this demand zone, the most recent demand zone, and right now it's trying to create a new high low before pushing to the upside, right? So this is one of the scenarios where it's extremely high probability to actually look for longs as well. And right now, since the internal order flow has already shifted bullish and the pullback is over, we're expecting price to take out this swing high right here to continue creating a new higher high and potentially a new high low very, very soon on the higher time frame, which is why it's incredibly low probability to look for sales at this area right here, because even though it's an unmitigated supply zone that we have on the left hand side, like I said, it's because we are trading against the internal order flow. Alright, so this is pretty much the A+ setup checklist that you can put inside your trade plan. You basically want to be trading pro internal order flow with the internal structure, and you also want to be entering at high probability point of interest. I'm talking about those zones where it's aligned with the higher time frame order flow, right? So demand zones in a bullish market structure and supply zones in a bearish market structure, and also your unmitigated zones, your extreme zones, zones that swap liquidity, flip plus sweep zone, so on and so forth, right? I've literally made like an entire lesson on how to determine high probability zones, which you can check out on my YouTube channel as well. And also, you want to trade those zones that have some form of available liquidity near it, right? Because we always want to wait for some form of liquidity sweep before we actually enter for the trade itself, right? So in this case, you can see it's high probability to enter for a buy right here because we are trading at a demand zone that is aligned with the bullish structure and is also unmitigated, and there is also available liquidity sitting above it right here, right? You can see right here, liquidity over here. We are waiting for that liquidity to be swept. I'm waiting for price to mitigate this point of interest before the huge push to the upside. As simple as that. With that said, let's go onto the charts and actually apply this entire framework on there. Alright, so right now we have a blank chart on the screen on GBPUSD. This is live market at the moment, so I'm going to map it out with you guys to actually help you understand which are the low probability scenarios which you want to be avoiding, and which are the medium probability scenarios which you can consider trading, and which are the high probability scenarios which you definitely want to trade, the A+ setup. So obviously the first thing we want to do is to define our swing range, right? So that we got a bullish break of structure to the upside just like this, which tells us that price is in this bullish market structure right here, and we can identify our swing low right here, and then we can also identify our swing high up here as well. So just by doing that alone, you can see that we have really narrowed our focus into this tight range that we have right here. All right, so the next step is to mark up your point of interest, obviously, right? So over here, we got our extreme demand zone. You always want to make sure you mark up the extreme zones first, right? To make things a lot easier and cleaner. So you can see this zone is extreme demand zone that also swept available liquidity as well, right? You can see it swept available liquidity from this low right here, so we can definitely pay attention to this zone right here. And then there is also another near zone that we have right here, right? You can see what we have over here was price goes up, pulls back, goes up, mitigate this zone, and then push up here, came down here, and then push up, right? So based on that alone, I can easily just identify 3 different zones that we have right here. Okay, there's one right here, and then there's another one right there. I wouldn't personally draw this on because of the fact that price is already like blow right past it, so I can just erase it, keep my charts as clean as possible. Okay, so over here we got your swing low and your swing high. So everything in between your swing low and your swing high is counted as your internal structure, right? So all of this right here will be your internal break of structure, right? All of these movements right here. So what you want to do is to also map out your internal structure, right? So all of this will be an internal structure that we have right here. Okay, this is internal structure right there. All of this will be your internal break of structure to the downside itself, right? So let's just quickly map all of them up right there. All right, so if we jump down to the 50-minute time frame, it'll be a lot clearer, right? You can see over here. And if you look at this right here, we pretty much got a market shift when price actually came down there and take out this low that we have down here, right? So that's our market shift right there, which signal to us that the pullback is starting. All right, so quickly look at the drawing right here and just compare it to the live market conditions, and you will see that it's actually extremely similar, right? That's what happens when you can actually understand market phases. Everything becomes so much more clearer, right? So in this case right here, let's start mapping out our medium property scenarios, which would be this one right here, right? So the reason why this is a medium property scenario is, like I said, if you're trying to look for shorts, right here, you are still trading against the internal order flow, which is heavily bullish, right? So it's not the ideal situation to look for shorts. The ideal situation, the high probability scenarios, is when we already got a market shift, right? You can see when over here, price started giving us a market shift, which signaled to us that supply has overpowered demand. And right now, price is potentially shifting bearish to facilitate a pullback, right? So looking for shorts at all of these supply zones that we have right here is gonna be extremely high probability. Okay, so let me just quickly map out like the supply zones that we have up here for you guys to see, right? There's one right there, and then there's potentially another one right here, and then there's another one right here. All right, remember, the high probability shorts is always going to be the ones after market shift, right? The market shift is a confirmation that tells us that the internal structure has shifted bullish to bearish. All right, so in this case, if I were to mark up my high probability scenarios, it'll probably be after the market shift, and you'll probably be at this short right here. Okay, this short right here, and then potentially at this short right here as well. Okay, so there we go, right? So you can see these are the high probability scenarios which you can look for shorts. I'll say over here is also somewhat high probability. Main reason is because you can potentially see like a market shift on the lower time frames right here, right? So if I go down to the 5-minute or the 1-minute time frame, I can probably see some form of market shift right here. So by rights, you can already start looking for shorts like at all of these supplies that we have up here as well, right? They are deemed as high probability. But if you want to be more conservative and play it safe and wait for the 15-minute structure to shift bullish, then yeah, these two will be good times to actually look for shorts. Now, with that said, let's not forget about our premium and discount, right? So if I draw my premium discount tool right here, what do we say? We say that when price starts entering the discount pricing, it's gonna become lower probability to look for shorts, right? Lower probability to trade counter trend. Main reason because of the fact that at any point of time right now, price can just start shifting bullish and the pullback could be over and price can just continue going up even higher, right? So this one right here, I will argue that this is medium probability, mainly because of the fact that we are already stepping into discount territory itself. Okay, all right, so if I zoom in here a little bit, you can see that price has potentially mitigated this demand zone that we have down here. And guess what? It also swept the available liquidity below this little low that we have down here, right? Just like what we saw in the diagram itself. Okay, so this was that last internal break of structure, which means this is that last internal lower high that price has to hold in order for it to remain bearish, right? So in this case, what happened was that price went up there, right? Reacted from this supply zone that created this break of structure right here, but then it did not go down and create this low right here and create another internal break of structure. Instead, we got a failed reaction right here, which tells us that demand has overpowered supply. And right now, the internal structure has officially shifted bullish itself, right? So there we go. We can mark our little market shift right there. And now our internal structure is officially aligned with our higher time frame bullish structure, right? So in this case, you can mark up all the demand zones that we have down here, like this 15-minute demand right here. And then there is also another demand zone right here, right? Which price is potentially mitigating before, we push to the upside. Okay, so over here, we have not gotten a bullish break of structure to the upside to confirm to us that this market shift is valid yet. What I'm genuinely waiting for is for price to potentially take out this high right here, which give us a very clear break of structure, which tells us that this pullback is definitely over. And right now, internal is aligned with the higher time frame bullish order flow. And then that is where I'll start looking for longs when price start potentially pulling back and create like some form of high lows right here before I push to the upside, right? So these are the areas where I want to be trading at, the high probability scenarios, the A+ setups, where the point of interest that we have right here is pro internal order flow. And it's also a high probability point of interest, right? Obviously, it must be some form of point of interest that is pro-trend, unmitigated, filled with imbalance, have available liquidity, so on and so forth. And also, we need to wait for some form of liquidity sweep before we actually enter for the trade itself. So with that said, remember that the edge isn't in having more setups and trying to trade every single scenario in the market, but it's more in filtering out all the garbage, locking into one setup that actually works and scaling it with size and confidence. So if you want to learn the full system, I break it all down in excruciating detail step by step inside my free 13-hour market mechanics course. It's the same framework that took me from blowing $20 accounts to making 100K a month with complete clarity. You can just get a full course for free, link in the description. And if you want to learn how to actually enter properly, you can check out this video next. Right, choose one and I'll see you there. And remember, you're just one trade away.